Let's go ahead and talk about the case of a partially owned subsidiary acquired at book value, so there's going to be no differential. Okay, first some background. Now, when we acquire less than 100% ownership of a subsidiary's common stock, that means that there's someone else out there who owns the remainder. That other party is referred to as the non-controlling interest. Now, it used to be that those people were referred to as the minority interest, or the minority shareholders. We were the majority shareholder, they were the minority shareholders. And you still see that term used occasionally, but the preferred term is now non-controlling interest. The problem is that when we combine the balance sheet of the parent and the subsidiary, not all of the assets and liabilities of the resultant combined entity are owned by the parent company shareholders. Some portion of the subsidiary is owned by these other people, and we need some way to indicate that part of the whole is not owned by us, the equity holders of the parent corporation. Similarly, when we combine the income statement, we're going to be combining the revenues of the parent and the subsidiary and the expenses of the parent and the subsidiary to get the income of the parent and the subsidiary. But again, we, the parent company shareholders, don't own all of that income. There's somebody else out there who owns a portion of the subsidiary's earnings. Now, it used to be that we would only record our share of the subsidiary's assets, liabilities, revenues, and expenses on our consolidated financial statements. If we owned 70% of the stock, we would consolidate 70% of the assets, 70% of the liabilities, 70% of the revenues, 70% of the expenses, and so on. Now we've changed that and we consolidate 100% of those items, but again, we need to create some new accounts to indicate that not all of the resulting combined entity is owned by the parent company shareholders. Now let's go ahead and do a simple example of a consolidation at date of acquisition. Let's go ahead and assume that on January 1st, 2001, the ever-present big company acquires 70% of the similarly ever-present little company for $210,000. Little company's book value on that date is $300,000, and all of their assets and liabilities have fair values equal to book values. The fair value of the non-controlling interest is $90,000 on that date. Okay, first we have to do our cost versus book value equals differential analysis. And here we're going to need both a column representing our share, our 70% of little, as well as a column accounting for 100% of little company. So first we have the cost, slash fair value. Our cost was $210,000. The total value, our share is worth $210,000. The non-controlling interest is worth $90,000. So the total value is $300,000. The book value, again, that was given as $300,000. That's the total. Our share of that is $210,000. So there's no differential. Now let's go ahead and assume that big and little have the following balance sheets immediately after the acquisition, so on the date of acquisition. Now instead of listing assets and liabilities separately, let's just go ahead and call assets minus liabilities net assets. There's no reason to clutter up the presentation by saying current assets and long-lived assets and current liabilities and so on. Let's just have a single number representing net assets. So here we see that, again, little company has net assets of $300,000. That's matched by their owner's equity, common stock and retained earnings, $100,000 and $200,000. Big company has $790,000 in other net assets, plus their $210,000 investment in little, for total assets of $1 million even. And again, their common stock and retained earnings, $400,000 and $600,000, to a total of $2 million. Now again, if we were to simply add across the net assets, the total net assets are $1,090,000. Now the problem is that we, big company, don't own all $1,090,000. We own all of ours plus 70% of little's. The non-controlling shareholders own the other 30% of little's $300,000 in net assets. So for our elimination entry, what we're going to do is we're going to eliminate the subsidiary's beginning of period equity accounts like we always do. We're going to close that against our beginning of period investment account, and we're going to go ahead and create this new equity-like account called non-controlling interest, which represents the portion of little company owned by the non-controlling shareholders. So again, for our our S entry, or as the textbook refers to it, a combined R and E entries, we eliminate the subsidiary's beginning of period owner's equity accounts. We eliminate our beginning of period investment account. Again, we paid $210,000. And we go ahead and create this new equity-like account called non-controlling interest. And again, that represents 30% of Little's total value at the beginning of the year, $90,000 in this case. So we're going to post that elimination entry to our worksheet. Again, we have debits to common stock and retained earnings in the debit column, credits to the investment and the non-controlling interest in the credit column, and we add across. Again, net assets adds across 790,000 plus 300,000 is 1,090,000. The investment in Little account gets canceled out to zero like it always is. The common stock and retained earnings accounts, again, we eliminate the subsidiaries' equity accounts like we always do. We're left with the parents. And then finally we've got this new equity-like account called non-controlling interest. A longer title would be non-controlling interest in net assets of Little Company, $90,000. Now I apologize, some of these tables we're going to be doing, to get them to fit in the PowerPoint presentation, I had to use fairly small fonts, so I apologize in advance. Also, I had to abbreviate a little bit in terms of the account titles in the worksheets. Okay, let's go ahead and extend this now and say, okay, that was the date of acquisition, January 1st, 01. What happens at the end of the first year of ownership? So let's assume that it's now the end of the first year following the acquisition. Let's assume that during the year Little had income of 30,000 and paid dividends of 10,000. A worksheet with very summarized or aggregated data might look like this. And again, basically I pulled all these numbers out of thin air with a few exceptions. I chose revenues and expenses for Little so that their income would be 30,000. I chose assets and liabilities for Big and Little so that their balance sheets balanced. I had the investment income for Big Company such that it was 70% of Little's income. And I had the investment in Little balance. I had to pick that specifically to represent the beginning balance of 210,000 plus their share of Little Company's income less their share of Little Company's dividends. But other than that, the numbers are all chosen sort of randomly. And again, the problem we're going to see is if we were to simply add across the revenues and the expenses, the revenues we'd add across 300,000 plus 100,000 is 400,000. The expenses we add across 271 plus 70 is 341,000. The investment income always goes away, and so our income would be $59,000. But again, the problem is we, Big Company, don't own all $59,000. We own all of our income, plus we own our proportionate share of Little Company's income. So what we need to do is create this new account called income to non-controlling interest, which basically says out of that $59,000, some portion of that is owned by these other people, the non-controlling shareholders. Okay, so we're going to go ahead and allocate the non-controlling interest their share, in this case 30%, because that's their ownership stake, of the subsidiaries' adjusted and realized income. The subsidiaries' reported income is $30,000, and there are no adjustments in this case. We'll talk more about that later. So the interest of the non-controlling shareholders, they get 30% of $30,000 or $9,000. So of the combined earnings of $59,000, the non-controlling shareholders get allocated $9,000, which means $50,000 left for the controlling shareholders. Now, I want to stress that income to the non-controlling interest, or the income to the non-controlling shareholders, is simply an allocation. We're taking the stated total income of $59,000 and saying this part's yours, this part's ours. We're not actually giving them any cash, we're not actually doing anything like that. All we're doing is doing an allocation such that we're saying that part's yours and this part's ours. Let's go ahead and go through our elimination entries. Again, first we have our S entry, where we're going to eliminate the subsidiaries' beginning of year equity accounts and go ahead and eliminate our beginning of year investment. Again, that was on January 1st, our investment balance was $210,000, and we create the beginning of year non-controlling interest. Again, at the beginning of the year, the subsidiary was worth $300,000. The non-controlling shareholders owned 30% of that, or $90,000. Next, we have A for amortization, and that's not applicable because there was no differential in this case. I for investment income. This should be the easiest entry of all. We look at the big column, and we see the word investment income. It says $21,000, and so that's what we have to eliminate. So investment income would have a credit balance if it's a positive income. So to eliminate it, we're going to debit investment income and credit the investment account. Now we do have something new. We need to eliminate 100% of Little Company's dividends. So they paid, looking at the worksheet, almost dead center, up top to bottom in Little's column, we see the words less dividends, $10,000. So little company paid dividends of $10,000. 70% of that went to us and was deducted from our investment balance. Again, when we got that under the equity method, we would have debited cash and credited investment in little. The other 30%, or $3,000, was paid to the non-controlling shareholders. Now, just as when we receive dividends, that reduces our investment balance under the equity method. Basically, the argument is they pay dividends, that reduces their equity, that reduces our claim on their equity. Same thing applies with the non-controlling shareholders. When dividends are paid out, that reduces little company's total equity, which reduces the non-controlling shareholders' claim on that equity. So although the non-controlling shareholders started the year with $90,000, because of the dividends that reduced equity, therefore it reduces the non-controlling interest by $3,000. Finally, we have our new entry, Inc., INC, whether that stands for income to the non-controlling interest or I, income, to non and controlling C, interest. We need to go ahead and record that $9,000 allocation, the income to the non-controlling interest, up in the income statement, and we increase the non-controlling interest, that equity-like account. Again, just as when little company, under the equity method, when little company reported income, our argument was their equity has gone up, therefore our investment needs to go up because our investment represents our share of their equity. Same thing is applying here for the non-controlling shareholders. When little reports income, that means that little's equity goes up, which means that the non-controlling interest goes up as well, because the non-controlling interest represents their proportionate ownership of little company's equity. Okay, let's go ahead and post all this stuff to the worksheet. Again, debits to the debit column, credits to the credit column. A couple things you need to be careful of. First, in the S entry, be real careful when you see that debit to retained earnings. We always adjust beginning retained earnings. Again, there's beginning retained earnings in the worksheet, and there's ending retained earnings. Be sure to debit beginning retained earnings up in the middle of the worksheet. Secondly, note that there are two different accounts with the word investment in the title. We have investment income, the income account, and we have investment in little, the balance sheet account. You need to be sure you know which one you're dealing with at a given point in time. In the S entry, we're closing that against our investment in little account. Likewise with the non-controlling interest, there are two accounts with the words NC interest in it. We have the income to the non-controlling interest up in the income statement, and we have the equity-like account called non-controlling interest. You need to be really careful and really sure that you know which account you're dealing with at any specific point in time. In any event, we continue to post the remainder of those entries, and I didn't do it in making up this PowerPoint presentation, but it really wouldn't hurt to take a few seconds to go ahead and add up the totals in the debit column and the totals in the credit column. So just looking at this, we got 21 plus 9 is 30, plus 200 is 230, 237, 337, $340,000 on the debit side, and we have, I'll take my word for it, $340,000 on the credit side. So once we post everything to the worksheet, now we come to adding across all of the appropriate rows. And just like we did before, we add across the revenues. 300,000 for big plus 100,000 for little with no adjustments is 400,000. Expenses we add across. 271 plus 70 is 341 with no adjustments. The investment income gets closed out to zero like it always does. When we get to a subtotal like income, we no longer add across that row, we work our way down the consolidated column. So consolidated revenues, 400,000, less consolidated expenses, 341,000, gives us income of 59,000. I was hemming and hawing about calling that consolidated income. Yeah, we'll just call it consolidated income. Of that $59,000 total consolidated income, again, we've determined that 9,000 of that goes to non-controlling shareholders. Again, we just took that income to NC interest and took that debit and moved it over to the consolidated column. And so what's left is the income to the controlling shareholders, $50,000. And again, we immediately take that down and put that in the statement of retained earnings. So now we move down to our statement of retained earnings. Again, beginning retained earnings, we've eliminated the subsidiaries' beginning retained earnings. We're left with the parents. Add the income that we brought down from up above. Subtract out the dividends to give us our ending retained earnings of $620,000. And again, we immediately take that $620,000 down to the balance sheet as ending retained earnings. Now we're on the balance sheet. Net assets, we simply add across. 796 plus 320 is 1,196,000. The investment in little account goes away as it should. The equity accounts, common stock, again, we eliminate the subsidiaries' common stock, leaving us with the parent's balance of 400,000. Retained earnings, we brought that down from up above, 620,000. And then finally, we've got this new equity-like account called non-controlling interest. And again, we started with 90,000. Then the credit is positive because it's an equity-like account. So we started with $90,000 on the credit side. We gave them $9,000 more because that was their share of the subsidiary's income, so we're up to 99. Then we took away 3 because they received some dividends. So that's down to a $96,000 final balance.